a little bit more about what are those different types of financing that are available to companies? Again, I know we have a number of founders in the room that are scaling up their businesses, but can you sort of level set what that playing field is like in terms of options that are available to companies as they grow and scale over time?
So I'll start with the basics. There are 3 buckets of capital. One, you get capital from your customers. That's called bootstrapping. You have a product or service, they pay you for it. And the more customers you get, the more capital you get. And many companies have grown through bootstrapping. The second is equity. And equity is capital that is put into the company in exchange for a share of the ownership. But it has no requirements to be paid back until the company is sold. And I will get back. In some cases, if you're an owner, you could get a share of the profits. And we're starting to see that some businesses that won't grow up to be sold or go public, if you're an owner, you can get a distribution of profit when the company becomes highly profitable. And then the third bucket is debt. And I think Betsy will talk a lot more about debt. The issue with debt is it's a metronome. It has a fixed payment requirement. It has generally, the terms are known. And if you have a very uncertain business, think about being on a swing where you're over land. If I fall, no problem. Oh my God, I'm over the crocodile pool. I don't want to drop now. So you've got to know where you are. So if you have great uncertainty in your business, debt can be a little scary, and it can sometimes work. And the good news is about debt is most lenders won't lend you business if they think you're not ready for it. So never hurts to ask. Sometimes you'd be surprised. And there's some hybrid things that go on that sometimes you can get debt that can convert to equity in certain cases. There are some community and governmental support and grants that can come in. We've seen a lot of company, especially if you have a technology, that will often start with grants, which is that's capital that it's granted to you. You get to use it as you want to complete your research without having to pay it back in debt or having to get a share of the profits or give up ownership. But those are the 3 sort of general buckets. And the other part of businesses is you can do all of the above. So it's not like, gee, I'm on the bootstrap path. That's the only thing I'll get. Or I want to go raise equity. That's it. I can do that. There are businesses that have done all 3, and that's totally fine. So as the conversation goes on and we get to Q&A, happy to answer. And one question you get a lot is there a right way to do that? And the answer is, it so depends on your business, where you are in that journey of developing your company and what you want to do. So for all entrepreneurs and something at Branch Venture Group, we spend a lot of time trying to understand what does the entrepreneur want to do? And because that really influences as a capital provider, whether my type of capital fits their goals and their interests. And those have to be aligned. So with that, maybe I'll turn it over to Betsy.
Thanks, Marcia. Yes, debt can be scary in the early stages, but it's not meant to be. I think to Marcia's point, it's a matter of understanding where you are in that life cycle of your business. I think I would say from a commercial banking standpoint, we certainly don't aim to fund cash burn and growth with debt. Equity is much better for that. It allows you that flexibility to really invest in your business, not worry about the bottom line just yet, because when you're talking to a lender, they're going to want to have a clear path to their repayment. So if you're still in a high cash burn mode, that becomes a tricky metric. So, but that said, as you grow and scale, and also to Marcia's point, debt and equity can certainly exist together. And as it makes sense, and as you really create a plan and a path to possible profitability, if you're not there already, there are certainly lots of structures. I think one great thing I've learned over the last 5 to 10 years working with really high growth companies or early stage companies is we can be creative. And as long as, we're kind of on the same page as far as the market you're addressing and kind of the overall opportunity, there are certainly conversations we can have.
And it's been interesting. I think that there's been even more creative ways that companies have been funding their activities to date. I think crowdfunding is one way, whether that be through equity or loans. Inventory financing has been another way. Some of you may be familiar with inventory financing for food-related companies. In times of necessity and when it's really difficult to find capital, there have been a number of new platforms created, and we've had experience with some of our entrepreneurs leveraging them to support their business growth. So I don't know if any other creative sort of forms of financing come to mind that you've seen companies leverage over the years, aside from the more traditional ones, but would love to know if you've seen anything else. Or you could think about it. We could talk about it later.
I would say just even structures of debt, right? So, certain metrics we might look at, whether it's, if you're a technology or a software company, for example, and you have recurring revenues, we can sort of lend against those if you're not yet profitable. I think if you're trying to scale a consumer business, a food business, we can certainly take a look at inventory. Food is perishable, so that can be, there's certain nuances there, but there are certain ways, there are certain structures that we can always look at.
Yeah. Thank you. So Michael, as the practitioner of this funding for food businesses, you've self-financed a lot of the growth that you've had over the years. So sort of take us back to that, those initial scaling phases and how you really thought about, how am I going to make the product, to sell the product, to be able to get people to eat it, to be able to garner their interest enough to be able to continue growing. How did you think about really supporting that growth over the years?
So early on, we tried to get capital through kind of traditional ways, right? We looked for debt from the banks. We looked for, I remember I couldn't even get a $10,000 line of credit. I think we were trying to find, we were just trying for overdraft protection, and we couldn't get overdraft protection. I won't tell you which bank, but really, it was a struggle. And so that's where, I think getting creative really is important. So when I was talking about leveraging terms with customers, that's really important. We would not be here today if we didn't do that. So make yourself invaluable to customers. So Whole Foods is an example where for years we've created jobs for ourselves with Whole Foods that are outside of what we do. We didn't really make any money. For instance, we distribute all of Whole Foods mushrooms pretty much. Even mushrooms, we don't sell them. This West Coast exotic mushrooms, wild mushrooms that get flown in from all over the world, we take them in-house, we inspect them, we distribute them to their distribution centers for them because we know mushrooms, and we just did it as sort of a courtesy because they were struggling with something like that. So becoming that kind of backbone where they couldn't leave us, they couldn't drop us with our mushroom line because they also needed us for this other thing we were doing. But to give you an idea, one of our vendors, we were able to negotiate 60-day terms with. So when we were doing somewhere around, say, $50,000 in revenue early on, if I had 60-day terms with them and I had, say, 10-day terms with some of our larger customers, if I was doing 50 grand a week, you're talking several weeks of 50 grand, right? So every time I brought on new revenue, I brought on new capital, which made my balance sheet look atrocious, but it gave us the capital we needed to grow. So I think it's something that I was able to take to the extreme with 50 days of terms and cash. But I think there's middle ground in there where potentially you can find a way. And I think working direct to consumer is a really, really good way to do that, right? So if you're working direct to consumer, it's cash in hand in the account. And when you're able to negotiate terms with your vendor, if you can get 30-day terms and you can sell your product consistently, all of a sudden bootstrapping becomes something that's realistic. So for us, we were able to leverage that to get some realistic financing. When we were able to get to the point where we were doing significant revenues and starting to get closer to profitability, we were able to talk to people like Business Development Company of Rhode Island and they were willing to kind of go out on a limb. And I think what's important to mention, I've mentioned Peter a few times, but there are the large commercial bank lenders, right? But there are some, and I'm only familiar with Peter, but there are lenders out there that are funded by JPMorgan and Bank of America and other larger institutions that are there and in place to help businesses that aren't quite ready for commercial banking. And they have other tools that they can use to help you find financing and to help get some cash in your hands. But for us, I mean, the biggest thing that I remember was absolutely finding that way to really digging and getting creative with finding capital. I mean, it was the only way we survived. Absolutely. And also, taking risks. If you're going to do this, are you in, or are you kind of 1 foot in, or are you all in? We were all in. I can tell you that because I remember getting that $80,000 loan from Can Capital, and thank God it's gone, right? But those are the kind of things that if you believe in what you're doing and you really think you can make it, you got to take those types of risks.
Would you do anything differently today? Now, in hindsight, it's always 2020. Would there have been other resources that you would have tried to, access, or just a different strategy that you would have employed a little bit earlier based on what worked and what didn't?
So that's an interesting question, because I think out of necessity, I did it the way I did it. And I think now I have the tools and knowledge to maybe raise some venture capital and there's things, and I'm glad I didn't. So that's something to keep in mind as well. So VC isn't always the best, right? It's not bad, right? It can be a great tool depending on what kind of scaling you're looking to do. But for me, I'm really happy that I own the company solely at this point. So, there's a lot of benefit if you can. I paid myself $25,000 a year for 5 or 6 years. So thank God I have a wife that was able to support us. But bottom line is, if you can make that work, in the end, I can promise if your business becomes successful, it will be worth it. Now I answered to just me. And the idea of having a venture capital group kind of looking over my shoulder definitely would scare me.
I think venture has become more accessible to food-related companies over the years. After I suppose just success stories have emerged related to, food-related product companies being able to launch and grow and scale and potentially be acquired, relatively short into their existence. So I feel like we're operating in a unique kind of funding time, and these different sources of capital are, kind of potentially more available today than maybe historically. I also think you're touching on something interesting, which is, knowing what kind of company you want to build and really mapping then the financial strategy to what that company is, right? If you're looking to, sell your company to Mondelez, you may have a different financing strategy than if you're just looking to build, a 15-person team and, keep the business relatively regional or local. Both are completely fine. But in that case, then the different types of capital the requirements that you have are just different.
Well, what can I say? One thing. The other thing is what's important for me, I knew I didn't want to be working in the mushroom grow rooms every day. I knew that from the day I started. I was really interested in the systems and how to build the grow rooms, but I knew that I wasn't going to be the guy that was packing mushrooms and growing mushrooms and just delivering mushrooms every day for the next 30 years. That wasn't my goal. My goal was to get to the point where I could focus on other things. But that doesn't mean that's, needs to be your goal, right? There's a lot of people that I know that have businesses that they really want to do the day-to-day. But I think it's, to touch on your point, it's really important to kind of know that going in. I remember I was standing in a walk-in packing mushrooms at Sweetberry Farm in Middletown. We were packaging our 40 pounds of mushrooms. And I told my business partner at the time, I said, in 3 years, we're going to be, moving tractor trailers of these mushrooms. And because I had that goal, right? I set those types of goals for myself. And I think those types of goals, identifying them and saying, okay, that's really where I want to be. And then maybe writing them down and having a plan and kind of understanding that first is really important, because absolutely it tailors what kind of financing you'll need.
I just wanted to make a comment around the venture capital role and their interest in food or not. And one of the historically, and there have now been enough venture capitalists depicted on TV that you sort of get the picture of meets an entrepreneur and starts to drive for, do you have patents? What's your intellectual property? If you've watched the Shark Tank and you've seen all of that kind of driving, and this idea of where's your edge and do you have anything proprietary? And most VCs tended to think that would lie in a patent or software code, an algorithm, something very firm. What venture is beginning to realize in food is that proprietary edge can be your customer relationship. So when Michael talked about Whole Foods, why would Whole Foods go to another mushroom vendor if you're servicing? So this idea of service and customer relationships now being that proprietary edge that as an investor, I will go look at and say, hey, are they servicing? Is that likely to grow? And so a Whole Foods, if you're working in 3 or 4 stores, hey, they got hundreds of stores. Imagine my growth just sort of servicing them. So really beginning to think about those customers as really being that intellectual property you're developing. And I think that's realization is why venture capitalists are starting to look much more carefully at food and beginning to see that there's opportunities here.
Great point. Betsy, I'd love to talk a little bit more about, sort of what you look for in a company and at what stage, they're most appropriate for approaching JPMorgan and the work that you do. What is that profile? And then Marcia, it'd be great for you to answer that too. You can use mine if you'd
like. Sorry, can you repeat the question?
Sure. What is the profile of a company that is best suited to sort of approach you at JPMorgan and leverage some of the resources? And also, what are those resources that you're making available beyond potentially just the investing and loans?
So I will say, working in the commercial bank, I'm probably, I don't want to say later stage because we are working with early stage companies, but if you're really kind of in your infancy, there are, local regional banks. Our bank has a small business arm. So just know that there are resources there as well. I would say across the board, whether commercial banking or small business, or if you walk into our branch, we look to be advisors. So I would say there's no real right time except now. We love talking to companies at any stage and hearing the story, and not just there to say, yes, you can have this, no, you can't, but kind of hearing the story, understanding it, and hopefully being an advisor to you. Now, if you're looking for capital, will our answer always be yes? No. We might say now is not the right time, given what you've shown us, given what your numbers are, or how you're approaching the market, et cetera, but it doesn't mean that's the end of a conversation. I think, I have clients today that, I've been talking to for years and years and years, where at first it didn't make sense for us to come in from a lending perspective, but we've kept the conversation going. We've stayed close to the company. We've provided advice, and now we do have a lending relationship, as well as a lot of other, as well as a broader banking relationship. So I would just keep that in mind as you are growing your business. And if approaching a bank can feel daunting, it shouldn't be. We talk to a lot of companies every day, and can hopefully provide some perspective that's valuable. I will say that lending is one thing that we provide. I think I mentioned in the beginning, other services that I think are important are those, what everyone thinks is kind of boring, but cash management tools, right? And how you're really managing the funds, whether it's extending terms in one way or another. How can we help you with that? Are there certain technologies or platforms that might be helpful to you are some of your vendors we already know, there's a network opportunity there as well. So try to think of your banker or your bank as not just, a wallet that you might be able to dig into, but really broader resources as well as you're thinking about growing your business. But I think as far as things that we're looking for, I mean, to Mike's point, we're looking for you to be all in. Do you have a plan? Have you scoped out what your addressable market really is? How are you differentiating yourself from a similar looking product? You know, what traction have you had so far? You know, and obviously financial performance is something we can look at too. But those are really the primary things.
Great. And Marcia, what do you look for when you're evaluating a company for potential investment? What are they coming prepared with?
If I had to get down to one word, it's passion. You got to want to do this. And it can't be, well, I figure I'll try it for a while. If it doesn't work, whatever. It's not going to get you up. It's not going to get you out of the closet and being willing to live on $25,000 a year, when I'm sure Michael could have at any point made 3 or 4 phone calls and had a market rate salary and said, you know, there I am. So this real, what's your mission? What's your drive? It often gets told, what problem are you trying to solve and why are you trying to solve it? So I think that that mission and passion is just something, because it's a long road. It's a very long road. And whether you're starting out, whether you're a 10-year-old, $100 million company, I've worked with CEOs that, you know, different issues come up, a new competitor, somebody decides to cut price, a new regulation you got to deal with. So the wonderful thing is when you're in business, you're going to have to work in new environments. Today, we have rising interest rates. You may have had a plan and go, whoa, and in 2022, almost all businesses had to deal with supply chain. Costs went up, timing become very uncertain. Really interesting. And we may get into what we're looking at this year. So I'll save those questions. But I think that becomes really important. And the other piece is just getting back into what's the nature of the entrepreneur. Are they willing to listen? That may sound really simple, but Lauren and I have sat in meetings where we spent an hour with the entrepreneur. They didn't ask us one question. They were just running along. And I thought, wow, because such a key resource when you start to think about what is the right way to grow my business is to talk to people. In order to talk to people, you got to ask questions. So if you're not willing to ask the questions, you're going to lose. You know, are you there to really learn and figure out how to grow? So that, and I have walked out saying, I can't believe they didn't ask us one question. And so tip, whenever you meet a venture capitalist, minimally have 3 questions. You've got to have something. So that comes in. And you have to have, you know, a financial model that makes sense for venture. So now this is not all businesses should be venture backed, and happy to go into at some point or afterwards, what are those criteria? But just because you've got a good idea, you think you can grow a company and make money, it may not be suitable for venture capital. And venture capital does have some pretty high hurdles in terms of growth, profit, and an exit. Because as a investor, I used to joke, I have a pretty simple job. I give companies money and they better give me more back. So that exit, and if that's not something you really want to do, be very careful. But anyway, happy to go into any more.
No, being as passionate about running the business as you are about the product, I think is incredibly important. And we see a lot of that in food, right? You have this family recipe, or you have this life experience that's inspired you to start this food company, and, you know, that's awesome. But being as excited about, you know, the growth and the team build and the financial strategy and the, you know, 3 to 5 year financial projections that we ask for, and, you know, taking people through that vision, showing them that vision through the numbers and through the strategy that you've put in place, I think there's no better way to be passionate, to express your passion, other than, you know, demonstrating that there's a worthwhile business here based on what you're trying to do.
I think being teachable and listening is huge as well. When I started my company, I had the dream of, you know, growing mushrooms and selling them. And my job now is, you know, looking at spreadsheets and managing people. So entirely different from what my dream was, but, you know, that's where I'm best suited. It's what I'm best at. And the interesting thing is, you know, being able to be flexible with what you want and where you're headed, and listening is huge. I mean, one of the guide points for our hiring one of the things I've learned since, we started the company was how do we hire people? And one of the most important lessons we learned early on was that, what someone brings to the table, when it be skill set or whatever, is way less important to me than their ability to learn and loyalty and trustworthiness and like showing up. Those like 4 things, like I can teach them everything else. And I think that, if you can find those types of people to surround yourself with, people that are willing to learn with you, and just constantly trying to find, not being set. There were certainly times where I was like, oh, I have this idea. This is the way it's going to be. And I had to catch myself and say, wait a minute, this is not the right path. So I think being willing to say I was wrong and this is the direction I should move now and I need to pivot. There were a few times I won't even tell you, but there were a few times where that happened. And if I hadn't pivoted, I wouldn't be here today like this, so that flexibility is really important.
Great points. So I want to talk a little bit about misconceptions. What are the biggest myths out there that you've come across related to companies seeking funding or founders looking for capital, that we can dispel forever as part of the discussion today? Any one of you could take the. Oh, it is. Okay.
Well, I'll start. I think so. With a narrow focus around, should you raise venture capital? So you're going out in this mission to raise venture capital, and I think one of the biggest misconception is the name on the door is more important than the person you work with. And at the end of the day, whether a well-known venture firm or an investor that you really like, can get along with, can work, and being in relationship matters so much. I have seen there is nothing worse than you meet an entrepreneur, and I've met them, who took money from the wrong investor. Great name. They don't show up. They don't return phone calls. They're not there to answer your questions, or they have a very narrow view of how the business is going to go, which is maybe not in line with what the founder wants to deal with their business, and you're stuck because, as I said earlier, you're married, you are, and there's no divorce clause. The only divorce clause when you take venture capital is you're fired as the founder. That generally doesn't make the founder feel very good. So this idea of really knowing, is there a match? So personalities matter, and your chemistry. And if that little spidey voice goes, oh, they have a really good reputation, I don't know if I'd work well with them, listen to it, move on to the next. If they want to do it, there'll be others. So I think that that's really important. The other thing is, a lot of founders get a little hung up on valuation, and you got to grow. And sometimes you'll grow into your valuation. And if you do it in the right way, the pie will be there. But a lot of people get really hung up on, they want that ego or mark. And again, it's a signpost. It is not what's going to take you to the promised land of, achieving your goals, really generating a lot of, wealth for all of your effort that you put in. So I'd say that sense of value, don't let your ego. So those would be my 2 misconceptions. It's so much about the actual person you're going to work with, and is it somebody, and Michael used the word, is it somebody you trust? And if you don't trust them, if you get off a phone call going, oh, wow, move on. It will save a lot of heartache, and the heartache will come. And there are enough stories. So.
I think this is working. Thank you. I agree on, it's the person you're working with. It's the individual 100%. We call ourselves relationship managers for a reason, and that's because we intend to have long-term relationships with our customers and be there. So agree with that. I would say one of the biggest misconceptions as far as bank lending is really just that banks are there to hamstring you. We're not there to stunt growth. To my earlier point, We like to get creative. We want to get repaid, but we understand the growth. We understand the story of our clients, and certainly want to create a situation where if we are lending to you, there's room for you to do that. So I do think that's a misconception. And maybe when you're super early on, it can feel a little constricting, but at least in our business, we certainly try to create a buffer before, you trip a covenant or something like that, where we're both back at the table kind of having a conversation. But I do think that's a misconception.
I think one of the things I've noticed with early stage founders is that I have to raise money. That's another thing that I think's a misconception. I know a lot of companies that didn't really raise a lot of money. Maybe they raise some money from family and friends. If you can come up with a little bit of cash, you can start your business. And I think one thing that is really important for founders is to identify that the business can be successful in that early stage. So, raising some capital from, family and friends or money that you saved is hugely important, because then you're all in at that point, and you're moving down a path, and you have some answers to some of the questions that you asked early on. And I think if you do that, you'll maybe have some revenue, you'll have an understanding of the the market you're addressing, and that's a better time to try to raise capital than with an idea. So I think I did it with a credit card, a Home Depot credit card. So you can do it with anything. I mean, it was like a $5,000 credit card from Home Depot. So I mean, just get off your butt and do it is kind of like the main thing I'd say. And don't let that I couldn't raise that first million from the VC be your your stopping point. Just move forward, and you can do that in a lot of different ways.
Yeah, and I think you've all touched on it a little bit, but no is not no forever. And I think that a lot of entrepreneurs that we've spoken with on a number of occasions, they haven't been at the right point in their own development, or right fit for our processes when they come to us. And it might be no for now, but following up, demonstrating growth and change and success, filling people in on that progress. I think that that's some of our best portfolio companies have, they haven't all been no's at the beginning, but some of them have been. And, they've spent the time to build rapport and help keep people in the loop on how they've grown and succeeded. And I think that that was really conducive to, the end investment that we made through Branch Venture Group, and probably you've seen companies achieve as well. So. Well, I know we're getting close to time, and we wanted to provide some time for questions from the crowd, but predictions for 2023, how do you think the macro environment will influence the work that you do, if it will in any way?
I'm going to give one piece of advice that I think I've given to almost every single portfolio company that I work with. And it was an economic study done that talked about how does a company grow its market share. And it turns out, which is a little counterintuitive, the best time, the most cost-effective time to garner market share is in a recession. Because most people in recession, what's the first budget that gets cut? Ad and marketing. We're cutting all that. That's luxury. We're cutting that out. We're going right back to basics. We're going to focus on our key customers. Leaving those savvy companies can go out there and start to execute. So rates tend to go down. Customers aren't getting bombarded. They might be interested in, why is your service different? Why is your product better? Let me think about this. What are your terms? Are you going to be, more successful? How can I build an edge? So it turns out recessions, and economists are sort of, we haven't gotten into what shape will this recession look like? Is it going to be, a nice round bowl? Is it going to be, steeply coming out of? Is it going to be flat? But people expect it to be here. So I think it's a great time to actually increase your market share really cost effectively. So that is one thing to expect. The other is, as a venture capitalist, my kryptonite is uncertainty. I don't like risk, and I don't like uncertainty, and spend a lot of time working with the companies we invest in to try to identify what are the key risks and how are we going to work around them? In some cases, hey, if we can borrow money and kind of, build up our cash sources, that can be useful. So uncertainty is sort of our kryptonite. And right now we're in crazy uncertain times. So expect your investors to be nervous. So that would be two of my predictions.
And inform them before things get really bad. I think that that's been, a learning of ours, at least. People don't like bad news. And so to the extent that you can help, inform them of, uncertainty that may be happening, you don't want to save the worst news for the last minute. And I think, to the extent that you can tap into your financial partners to really help you figure out, what the future may hold is, the best use of, the relationship, quite frankly, beyond just the capital that's being provided. So
I think that's a great point. Build a downside case when you're thinking about financial planning, financial budgeting, and 100% talk to your financial partners. Surprises are not fun. So no one likes surprises. I think what to expect for 2023, we're in a rising interest rate environment. Expect capital to be a little bit more expensive. I think from the equity side, there's obviously cash to be put to work, but it's going to be a little bit of a different process than it was in 2021. I think debt will be a little bit more expensive, but manage your cash well, build a downside case, and to Marcia's point, there's opportunity in a downside. So certainly look out for that. From a valuation perspective, we are certainly seeing a little bit of a mismatch between what an investor might think your valuation is and what a founder might. So definitely be realistic about that as well, to Marcia's earlier point. But we are going to see softening. So that said, and we are seeing a little bit of a downturn in consumer activity, although it's just post holidays. So there's always a little bit of a lull, but, so TBD on if that trend continues, but, when it comes to food, we all need to eat. So, I think that's a positive, but, yeah, I think those are kind of the highlights for now. Thank you.
So I think one advantage we have in this room is that many of the groups are food related businesses. I think understanding your food related business and how it performed throughout the last recession is hugely key to understanding it. 2023. I looked at it as like a year in. I was concerned. We were coming out of a recession. I was already worried about the next one. But I can tell you that mushrooms grew 7% during the last recession. So I think it's important to understand that food tends to be a good place to be during a recession. So what does that look like for your specific category? So understanding that now before you put, lots of money in, finding the data, paying for the data might be useful for what you're doing. And I think, I'm certainly I look at this as an opportunity for our company, the downturn. Things, our costs go down and, we sell more mushrooms. So it's like there's absolutely an opportunity to be had depending on where you're looking at it. It even may kind of help guide the path to, the way your business is going to head. Maybe there were, I know early on, I always had 5 or 6 irons in the fire and I never knew which direction I was going. And, you find where does the revenue come from? Where's that profit center? So, understanding where that market, what happened during the last recession might help you to kind of hone down that target a little bit more.
Eternal optimism, a hallmark of a great entrepreneur. Awesome. Well, would love to open it up to the crowd. So if any of you have questions, please feel free. Mariana, go for it.
So the first question I'd ask is, do you have cash flow? So if you don't have cash flow to cover the debt, so then I would say you probably shouldn't. So for my case was different in the sense that we had cash flow, and agricultural businesses like mine are pretty steady. Also, I was in a position where I knew I was growing the company. So in the sense that, I when I took that awful loan, we were already doing a significant amount of revenue, and what I'm getting at is I wouldn't use it as startup capital. So I think you may find that that bank that's offering you that money would get into the nitty gritty, and they probably wouldn't give it to you if you don't have any revenue. You're going to have to find a better source, probably personal financing, things like that. Okay. Well, what kind of capital are you looking for? Like, how much money do you need? I think, so specifically, right. Okay. So that it takes 30 to 45 days to produce your product. Okay. And what's the hiccup with the cash flow? Like, what do you need the cash for specifically? Product, but the products, the labor, for co-packing. Got it. Okay. So, I mean, I don't want to start jumping in and trying to solve your problems for you, but I mean, I'm sure you've thought of them. I mean, I'm sure you've thought about it. If you have customers that are willing to purchase it, maybe they're willing to purchase it preemptively. So maybe you can raise that capital. You can buy it and say, "Oh, you're going to get it in 6 weeks." That's one. I mean, creativity is the mother of invention, right? So it's like, find that way to make it happen. I mean, for me, I did everything you can imagine. I worked as a snowplower. I mean, I just middle of the night, plowing roads, and then picking my kids up from school, and then going delivering mushrooms at 3 a.m. So like, you might have to work, 20 hours a day figuring it out. But I will say, I mean, if you have customers, there's a market for it. Find a way to serve it. And I mean, so there's a threshold of like $50,000 for the co-packing? Okay. Well, I mean, because bootstrapping sounds like something that could work in your situation where like maybe 50,000's, maybe it's something smaller, maybe it's doing 10 and then getting it co-packed, selling it, getting your margin, and just doing it as a part-time. That's what we did. I mean, the first 2 years I worked a different job. So, there's a lot of different ways, but
An incremental approach.
yeah, incremental approach. Yeah.
Any other questions? Julie, please.
I'm going to jump in before Betsy, because I think there are a couple of things. And one of my favorite aspects about food businesses, it's incredibly collaborative. I have yet to meet an entrepreneur who doesn't call another entrepreneur and say, "So how did you get that 50,000? What were your secrets?" And they tell you, "Oh, here's the bank I went to. This is what happened." Or, "I offered an annual subscription to somebody with a 20% discount if they paid 50% up front." I mean, they're all, and the ideas start flowing. Another really good thing is if you meet a couple, start a small peer group. And I've seen founders and CEOs really benefit. It can feel very lonely, like, I'm doing this all by myself. And you just hear no a lot. And worse than no, you hear not now, which is kind of like, I just wish or you hear nothing. It's like, was that a no? Is that maybe? And so sometimes getting a few people in your situation, maybe not direct competitors, that you can just call up and say, I haven't heard, do I still keep asking them, or they think I'm a pest and that's going to decrease my chances of happening? You know, what's going on? So a couple of things that really, but finding out role models, finding out different ones, and really, really talking, and stay away from bad deals. There are a lot of people that will lend you money for, and you were joking about the 3,000 interest rate, but we have seen a lot of our companies who wanted to finance inventory, and there's a lot. You can Google inventory financing. There are dozens, and the interest rates are staggering. You will go out of business, and you should not do them. And so if you go through and it doesn't make sense, don't pursue, because people think, well, at least the product will be in the market, I'll get from there. And then it doesn't, because you're now trapped into too much resource, too much money. So anyway, just a couple. Yeah, but but I think to the question, really important to talk to, something that I always stress when I talk to companies, because most important is be realistic. What can you really do within your control? Think about that, and then find, how do I get the resources to do that? Do your scenario planning. What happens if I'm dead wrong? If none of this happens, you know what? And also what if my product is loved and I need a lot more? Most companies get into not most, but a lot of companies get into as much trouble when they have over orders and they can't meet it. And then they go to a co-packer. And early on, we met some wonderful entrepreneur. Their minimum order was 500,000 units, and they were stuck. There was no market, but it was like the best co-packer for this product they had. And she tied up all this money on a perishable product that was never going to get through the channel in the Times, but had thought she'd take a chance. But so, but spend some time thinking about the upside, because oftentimes you need more capital and you may have to say no, and really thinking through. So understand your business from all those corners. And I think those are, the more you know about your business, when you go talk to a lender, you'll have those answers. And that's what Betsy is looking for. How well do you know your business? Not, I need $50,000. Why? So.
Yeah, I think, I would add on to that. The peer groups are huge. Talk to a couple different community banks. We're a national and global bank, but you'll see our branches around. Walk in and just talk, get their perspective. I would do the research and talk to a few different providers and just get smarter on kind of what's out there, what's available. Certainly before committing to anything that is as outstanding as what you said. But I think, obviously funding growth is tricky. You're at an inflection point, and, maybe there's a mix of equity and debt that you can find. Maybe there's an angel investor. I think it's really just learning what's out there and talking to a lot of people, which I'm sure you're doing, but yeah, just kind of even lay it all out as you have those conversations and compare.
Yes, but I want to be sure we answer Julie's question first, because I thought
I was
it was a
going to
really
mention
good one.
good touch point.
Yes.
Is Rhode Island Small Business Development Center also Commerce RI? So Josh Daly's in the room. Raise your hand, Josh. Although Josh doesn't really do this anymore. I know. But without Josh, Rhode Island Mushroom Company wouldn't be here as we are now. Josh has counterparts now that took over his role. Their job is, and they're free. It's funded by the state of Rhode Island, and I think it's the state, but whatever, whoever funds it. It's a great resource. They will connect you with lenders, and they will help you through planning you're looking at your projections, everything you may need to do to talk to lenders. So, and I think Josh might have introduced me to Peter. I can't remember for sure, but I'm just saying, like, that's how that works. So getting to know them and then talking to Commerce. Commerce has programs where, I think the 10, 20, 30, 40, $50,000 range exists at Commerce. I don't know the details, but those are really important touch points, and places that you can investigate. But I would definitely work with Rhode Island Small Business Development Center if you're in the room and looking for that kind of, yeah, okay.
And then I would add too, Branchfood has, been aggregating a lot of resources for entrepreneurs that are looking for funding and looking for capital. We've, built lists that, are inclusive of a lot of angel groups, or we run a network of individuals, but there's plenty of other angel groups out there that are looking particularly to support, different types of founders from different types of, backgrounds. And I think that's been, a great outcome over the last couple of years, is that there's now more targeted resources to, women, minority, otherwise run businesses that, are oftentimes the businesses that, we find a lot of women starting. So we'd be happy to share those resources with you. And Julie, to the extent that anyone comes to you with that request, we'd love to share those resources. So let us know. Kevin. Yes. Thank you. All right, one last question. Josh, go for it.
I mean, I think having, so your question is, how do you even start? How do you develop that revenue model, or? Oh, a lot. We do. We do our diligence. It's important. I mean, if you want to really boil it down, what would you ask if a friend asked you for $10,000 or $10 million? You'd really want to roll up your sleeves a little bit and understand the business and what the prospect of the business is. So, we'll kind of dig into the revenue model. We'll also do our own diligence on what we think the market looks like, the addressable market, and kind of look at competition. So we'll dig in pretty deep.
Do you share that research back with the company?
No.
I'm curious.
That's not true.
that's a big
great
part of,
question. I think we will, it ends up becoming a conversation. It's not something we'd publish and actually provide in a document, but it would become a conversation and say, here's how we look at the market. Here's how we see the competition, the competitive landscape. Would you agree? Are we missing anything? And really just fully and make sure we're understanding the scope. Yeah.
I think just from a venture perspective and the model, it has to fit with what you're trying to do. And one of the areas we first look at is margins. Because if you've got no margin, well, it means you can't bootstrap your business, first of all, so you lose that opportunity. Two, you have no money to invest in the marketing or the people or anything else. And so if if this is a new product that's never been done before and people have to learn about it, and you don't have the margins to actually do that promotional advertising, trade support, you won't get there. And so that I think it's that, is there a consistent story? If you're a Me Too product that everybody knows, so people say, wow, I just got out of this really interesting panel about mushrooms, and I met this guy, bootstrapped, I'm going to go do mushrooms and I'm going to go figure it out. And so I got this, I know how to now do it. You might have an easier time. No one has to explain what a mushroom is, and it's just going to be kind of price availability. Now, the question is, can you scale? Are you going to be able to meet some of the customers to displace vanilla mushroom? Probably not for a long time. So you really just have to think about that business, and that's what I look at. Is there something consistent about what you're trying to do? And it is not, there's no cookie cutter. All businesses are snowflakes, and they're all unique.
Well, I think that's a great note to end on. Well, thank you all for joining today. We're so thrilled to have you here and to be talking about this very important topic of funding food businesses. Should you be interested in learning more about Branchfood and the resources that we're providing to emerging companies, please talk to me, my colleague Marcia, my colleagues Tara, Carol, Olivia, Sarah are all here as well. If you could just raise your hands, they'd love to share more about our work supporting companies in many different ways, and we'll be around to network. And we would encourage you all to stick around and network as well. The space is available, and you can learn more about Branchfood and the work that we're doing at branchfood.com. Thank you for joining us. If you have any ideas for topics or other things that we can cover as part of future programming, please let us know, and would look forward to having you all join our newsletter and hope to see you at future events. So thank you for coming.